Take a look at the markets. Joining us now ahead of the opening bell, Ryan Detrick, Chief Market Strategist at Carson Group. After a great year last year, people thought maybe a reversion to the mean this year. So far, so good for 2024. More to come in the second half. Ryan?
Yeah, Joe, good morning. Thank you. And go Cincinnati Reds. As hot as the Reds are, the market's just as hot, Joe. You think about it, listen, May is usually not that great. And we just had a really good May. What I think people need to know, Joe, is that could be a signal, right? When you gain more than 4% in May on the S&P like we just did, June is higher 8 of the last 10 times. But more importantly, the rest of the year is up over 10% on average. It's double the at-any-time returns. That's just one signal. I get it. But, Joe, we're still seeing clues. I've come on with you guys for a long time now. So this is a bull market. But we're not changing our tune. We still think second half of this year is going to be pretty darn good.
The S&P next year is expected, in your view, to earn what, Ryan?
Yeah, well, this year they're expected to gain 11% right now. We think it could gain about 1% or 2 more, and then you go into 2025. Then, I mean, it's expected to be low double digits there. We think again a surprise can happen. I mean, people keep doubting this market, but again, what have we seen, right? I mean, just last week, Joe, on a pretty good upside, what happened? Put to call ratios go higher. Some of those sentiment polls became a little more skeptical. I mean, that kindling is still there overall for a summer rally. One more point: these 3 months we're in right now, June, July, August, in an election year, or last I checked, we are right now, usually pretty strong. So we think a summer rally still makes a lot of sense, Joe. You'd
prefer earnings continue to rise, or you could prefer a little bit of softness that allows the Fed to cut, or you'd like both?
Yeah, wouldn't we like both? I mean, you think about it, though, we're seeing that, right? I mean, we're seeing the softness. Just last week, you look at the ISMs, right? The ISMs, like manufacturing and services, both prices paid came down. Unit labor cost prices came down. So we're seeing some positives. And then again, the underlying pinnings of this strong bull market and this economy we're seeing, we don't see any major cracks. Other cracks, of course, there are some cracks. But overall, earnings are still strong and inflation's coming back. We think the first cut will likely be in September and one more in November from the Fed.
There are people that say it's still the breadth has not expanded enough, and you think that the soldiers come to meet the generals. You're not worried that this market's been propped up by the Nvidias and the Magnificent Sevens of the world?
That is a great point. And just 2 weeks ago, across the board, we're hitting new all-time highs or 52-week highs in various advanced decline lines. So, yes, believe me, we'd like small caps and mid caps to participate more. But we think that's the case. We think that's probably going to happen. I know other guests have pointed this out, but you look at PE multiples, small caps relative to large caps are as cheap as they've been since the late 90s. They had a 13-year outperformance. I mean, it's going to start right now, but we do think small and mid caps probably do pretty well the second half of this year as things do overall expand.
All right, Ryan, we've got less than a minute left. We appreciate it. We're going to take a quick look around the markets before we go. Ryan, thanks.